Okay, so next we're going to jump into the OK design policy. So we can see here that we're not looking too bad here. The year one cash value, we've put in 25,000. We've got a little over half of that, or not actually, little over half of that. So 12.5 would be half of that. So in cash value, that's not terrible, but still not great. And the differences here are very clear in that year one. So significantly less. And let's spot check year 10. So looking at year 10, we've put in that 250,000. We've got 316,000 in cash value, and we have 10,000 less in cash value and almost 12,000 less than that optimized fund level. So it's a good bit difference even in 10 years in. You've got that difference in value and death benefit. Okay, again, let's jump to year 20 in this OK design policy. We can see we've put in that $500,000 of cash into premiums, and we've got 969,000 of cash value and 2.15 million in death benefit. But we've got a difference of 16,000. That has gone into the cash value, the same funding level, but 16,000 is less. $16,000, almost $17,000 less than the optimized 25K funding level, and 37,000 less in death benefit at age 45. And now we're going to jump to when we stop funding this policy. Same thing. We're going to age 71 in funding this policy. 1.15 million in funding. We have 7.1, almost 7.2 million in cash value, and we've got a total death benefit of 8.265. We've got almost $100,000 less in cash value and almost 110,000 less in death benefit. So again, it's not terrible. If you stick it out with this OK design policy, you're not noticing that much at this stage of a difference. But the real stuff, like I said, the early liquidity hit is huge in difference. And we're going to pop down to sort of age 90, getting to these later years when you're closer to possibly passing away. So we've got 25 million in cash value. Same funding level has gone in. 26.5 million in death benefit, and we're looking at a difference of 330,000, and 353,000 in the cash value and death benefit difference, respectively. So when we're talking about numbers this big, that's not that much difference. So it is less clear in these IULs the difference at those later years when you start these policies out early. If you're young, these IULs can be fantastic tools for wealth growth. And that's what's really clear here. Even in these OK design policies, they're going to do pretty well if you start them early. All right, so now we're going to get into the fun stuff. We're going to go over to this optimized design, and now we're going to compare to the optimized design that's also the max fund with the max term blend. And that's where the funding is going to be different between these two. But this is where we can see, by being able to fund IULs, the thing about them is you can fund them for a very long time. You should cut them off probably no later than your 70s, 80s or so. That's sort of the if you have a high health rating, you're going to want to cut it off because the cost of insurance will start to get high. But now when we compare this optimized design, that's the design for the 25K fund versus the optimized max term blend, we're going to see some differences here because it is a different funding level. It's going to be a significant amount of time for compound interest to do its work and get you more cash that you can access and pass down to your beneficiaries, and also access during your lifetime to build further cash flowing assets. So again, in this optimized design, we've put in 25,000 in year one. We have 20,553 in year one cash value, and this shows a break even at year 4. This is based on, like I said, the return earlier. It's around 6 or 7%. You might do better than this. You might do slightly worse than this. I'd imagine over the long term, you're going to do better than this. But it's hard to say in any of these short terms, especially this next few years of economy. We don't know exactly what will happen. But by having that downside protection, so the IUL gives you that complete downside protection. So you can't have the value go down. Assuming you cover at least your minimum premium. I mean, if you don't have the money to pay your minimum premium, you can have that be deducted from your cash value. But if you're funding at least your minimum premium, your value should not go down, and you have that complete downside protection. So let's take a look at year 10 to compare with what we've seen in these other policies. We've put in 250,000. We've got 326,000 in cash value. But let's compare now to the optimized max funding with the max term blend. So this will have put in $184,000 less into this policy, but this will also have almost $247,000 less in cash value at this year 10 mark, and 711,000 or almost 712,000 less in death benefit. So it starts to pull apart, and we're going to see that as we go on. So if you have the ability to fund higher and hit these optimized term blend kinds of policies, it's a good idea to do it. It's a good place to store your cash. And we can even fund higher. It's just the ratio is not going to improve any more than this in the Allianz policy. But you could fund higher, comparative to like a mega backdoor Roth. If you want to be able to fund it that high or even higher, you can fund it $100,000 a year when we design these policies properly if you want to, or more. So there's a number of different ways, but let's continue to spot check the different values. So at year 20, let's take a look. We have put in that same $500,000 as compared to the other policies. Then we have 985,000, almost 986,000 in cash value, and almost 2.2 million in death benefit. So let's compare with the max fund, which the other one is putting in like $43,000 per year. So significantly higher funding level. So this policy was funded at 368,000 less than that max term blend policy, but we've got 739,000 less in cash value, almost 740,000, and we've got 1.6 million less in death benefit at age 45. So this starts to pull apart a lot as you let that compound interest and that extra funding level do its work. And let's keep going. So let's pop over to age 71 when we stop funding this policy or both policies. And we've got, again, 1.15 million has gone into this. We've got 7.2 million, almost 7.3 million in cash value, 8.3, almost 8.4 million in death benefit. And looking at this, the numbers start to really, really pull apart because that compound interest has been doing its work. Yeah, the funding level is $846,000 difference, and that's the total. So that funding level stays the same, and that difference is the max because this is the last year you put premiums in. But look at this: we've got 5.4 million difference in cash value, and almost 6.3 million difference in death benefit. So we're really seeing some major differences because we've let that compound interest do its work for a very long time. Okay, so let's go ahead and move down to where we're starting to get into the later years, age 90 again. In this case, we've put in that 1.15 million still. We're looking at 25,582,000 in cash value and almost 27 million in death benefit. But this is where it really gets interesting. So we've funded this 846,000 less than that optimized max fund max ratio of term blend. So this one's funded at $846,000 in difference, but at age 90, we're looking at 20 million difference in death benefit. This is a time when you're quite likely going to pass away, and an extra 19 million in cash value. So both of those are just giant numbers, and all of that comes from funding at $846,000 more over the life of this policy. And so, we're talking about funding for so a total of 46 years. So the funding difference does add up, but we can see that the cash value and the death benefit differences really do add up as well as we get into these later years. This video is part of a series. Check out the playlist here. If you want to learn more broadly about net wealth finance as a strategy and whether it makes sense for you, check out this playlist. If you're already ready to book a meeting, then check the video description. We could work with you to determine whether or not this makes sense for you to employ in your life. Thanks for watching. We'll catch you in the next one.